Hello, this is Connie Belden, and in this video we're going to talk about net present value, but we're going to add some additional scenarios to it. We are considering buying a new piece of equipment. The cost of the machine is $430,000. Working capital, additional investment you might need to keep that machine running, $145,000, but you would get that back at the end of year 4. Annual net cash receipts or revenues less the expenses is $160,000. Salvage value of the equipment, the one-time amount at the end of year 4, $74,000. Now in year 3, we are going to have to invest in some updates in the machine of $49,000. That's a one-time cost. And our required rate of return is 18%. So since some of these are annuity and some of them are dollar, we'll be using both of those. So for example, this is a one-time, so it will be the dollar table. This one we will use the annuity table because that is each year. The salvage value at the end of year 4, we'll use the dollar table because that's a one-time payment. And the cost to update the machine, we'll use the dollar table because that's a one-time payment in year 3. Okay, so keep that in mind. Okay, so let's start with the purchase price of the machine, and that's now. Okay, that would set you back as given $430,000. And you also have to invest $145,000 right now in working capital. So that would set you back as well. Next, let's look at the annual cash receipts of $160,000 per year. Now I said that's an annuity, so we're going to use the annuity table. And again, this is over a 4-year life. So therefore, an 18% required return. So therefore, I'm going to go to the annuity table. I'm going to look at the 4-year row, 18% return. So let's go ahead and bring that up. Annuity table, 4 years. At 18% is 0.2690. Okay, so I'll take $160,000, my annual cash inflows, times 2.690, and that gives me $430,400. Now that update at the end of year 3, right here, that $49,000 is a one-time payment in year 3 of $49,000. So we'll use the dollar table. Now I know the machine has a 4-year life, but this is going to happen at the end of year 3. So I'll go to the dollar table. I'll look up year 3 and cross-reference it with 18%. Okay, so 3 years. Go over to 18%, and that is 0.609. Okay, so you'll notice I did go ahead and write it out. So 3 years at 18% is 0.609 times 49,000. So 0.609 times 49,000. Now that's a cash outflow, so I'll put it in as a negative 29,841. Now at the end of year 4, that working capital of $145,000 will be released. That's a one-time payment at the end of year 4. And again, our required rate of return is 18%. So I will go to the dollar table because it's a one-time payment at the end of year 4. So look at the year 4 column, 18%. Okay, so here's a dollar table, year 4. Cross-reference over to 18%. And you'll see here that's 0.516. So I'm going to take 145,000 times 0.516. Okay, that is actually an increase in cash flows at the end of year 4 of $74,820 because you're getting that money back at the end of year 4. Now, you also have an increase in value from the salvage value of the equipment at the end of year 4. And again, we will use the dollar table because that's a one-time payment at the end of year 4, 18%. So it will be the same as a working capital, 0.516 as a discount factor. So I will take the salvage value of $74,000 times 0.516. Okay, so the purchase and the working capital right now are both cash outflows. The $160,000 I have coming in per year is a cash inflow. The repair at the end of year 3 is a cash outflow. When I release the working capital of $145,000 at the end of year 4, it's a cash inflow, but it's not worth $145 because value of money goes down as time goes on. So it's only worth $74,820. And when I sell off the equipment at the end of year 4 for $74,000, again, in today's value, that's a cash inflow of $38,184. Okay, so now what I'm going to do is add those together. And I get a negative $61,437. So if you need a minimum return of at least 18%, you should not do this project. Thank you very much.